Driftwood Acquisitions and Development was founded in 2015 to serve as a boutique investment platform that permits accredited investors to co-invest in yield-generating hotels through the syndication of equity post-acquisition.
Well, when I joined my dad, we're trying to come up with different ideas that we could, scale and keep control and flexibility. And, that really only occurred to us on a plane ride to San Francisco when we started doing his favorite napkin sketches of org charts. And we decided on Driftwood Acquisitions and Development, not just for the development, but for the acquisition side. And, now we've decided it's the best time for meetings is 30,000 feet up in the air. So we will continue to do that whenever we need to come up with something new.
When we started raising the GP fund, people jumped on it, and I guess it was a combination of factors. I mean, our track record of delivering good, healthy returns to investors and meeting their expectations, along with the combination of the product type that we're offering to people, which is a little bit new or different from what other people have been doing in the business.
Driftwood's unique business model allows local and international family offices and high net worth individuals directly invest in fully financed institutional quality and income producing hotels, while minimizing risk and benefiting from outsized returns.
We started with 2 hotels in Orlando, and it took us 6 months to place them, and there were smaller deals. And then, just earlier this year, we bought our largest deal in our portfolio to date.
Over the last 4 years, Dad has acquired 17 additional institutional quality hotels and broke ground on 5 ground-up developments throughout the United States. Dad's investor network, which started with approximately 80 investors in its first year, has expanded to over 600 active investors comprised from across the globe.
The key to Driftwood's success, and quite frankly, I think the key to anybody's success, is 1, focus on your customer. In our case, our customer is our investor. I want the investor to know that at all times we're working hard on their behalf and we're working hard to meet their expectations. And as long as the investor has trust on us, we will continue to grow. So that's, I would say, to me, the #1 key driver to our success. The other key driver, frankly, is our team. I love our team. Our team is family.
One thing that has changed since the beginning in our first acquisition is the size of our team. It was really just a few of us. And so we had to wear a lot of hats and do everything ourselves. It's amazing to look around the office now and see how much the company has grown, and that everybody really has taken on that entrepreneurial spirit, and it lives within the company.
Well, I was here pretty much from the start, and working first with Carlos and Carlos. It was like about 6 people in the office. Now we're up to 30 people, and looking at it growing every day has been so rewarding, knowing that all these ideas, all these dreams materialize, and they keep materializing, and the goals keep getting bigger, and we keep surpassing these goals. It's really something.
We have an incredibly talented marketing team in-house. We can use real-time analytics when looking at what's working and what we can improve on. What has been especially rewarding about this entire endeavor is that we've been able to broaden our reach and reach new demographics of investors across the United States and beyond.
Driftwood's strong partnerships with leading hotel brands, real estate lenders, and a sterling reputation among brokers enables it to stay ahead of the competition when identifying opportunities.
What sets Driftwood's underwriting process for development apart from typical private equity firms is probably the amount of deal flow that we go through on a monthly basis. Personally, I look at about 10 to 20 deals a month, and by doing so, we really weigh the risk versus reward for not only ourselves but for our investors to pick the perfect asset to include in our portfolio.
Driftwood's different than the corporate background that I come from. There's an open door policy here. If I ever have a question about something, I can just walk into Senior's office. It helps us be nimble when we're underwriting properties or in the middle of a closing process to make sure that things get done quickly. and in the best interest of our investors.
Driftwood Acquisitions and Development has also been a leader in the EB-5 industry.
So far, I'm very proud that we've helped about 150 families get that green card. And this is all the dreams for their kids, the dreams for themselves, starting a new life, coming to America. And here at Driftwood, we always take really good care of these families, making sure that not only their investment is safe, but they have a great transition into the USA.
As that ends 2019 and looks ahead to 2020, the company has numerous acquisition deals in the pipeline, as well as plans for 5 new developments. More importantly, Dad is expanding and building upon its successful business model through the creation of 2 new $100 million GP funds, which will position Driftwood and its investor network for sustained growth and success moving forward.
And we see so much potential with this model, with this company, with these people, that we felt that today was the right time to launch the next phase, which is essentially now broken into 2 funds, 1 acquisitions, 1 development, and it's going to really allow these teams to expand and grow in those areas and capture a wider share that I know will not be stretching our limits by any means. In fact, we're only scratching the surface still.
The most significant milestone to date, frankly, is now. Now, what we're going through at this moment. I am very proud of our legacy and our trajectory, and I'm very excited for our future. First of all, I want to thank everybody for coming over today to our 4th annual event. It continues to grow. We started the first annual event with 80 investors, and today we're well north of 600, I think approaching 700 investors. So thank you for the trust that you've put in us. We don't take it lightly, and we appreciate it very much. And we look forward to many, many years of continued growth together. Today we have a lot to discuss and a lot to cover. So we have the honor of having several amazing speakers and panelists here with us, and we'll be introducing them later. But now I'll let Carlos start with the presentation, and then I'll join in a few seconds. Go ahead.
Thank you again, all of you, for coming. It's incredible how much we've grown, as you saw from this video, from 2015 till now. See a lot of familiar faces, but some new ones, and we've expanded into a new room. So this is great, a great time. You've seen a lot of the video already. So I am going to talk about our business model in more detail to get you all familiar. For those of you that don't know how much of what we're doing. Essentially, this is the landscape of commercial real estate investment that you've seen from 1990 to 2012. It's been dominated by institutional investments and real estate. And so when you look at this graphic and you see this growth in institutional capital, that is how Driftwood Hospitality grew for years. From 1998, since its inception, with David Buttermeyer, our partner with Driftwood Hospitality Management, and the whole team was here, and you'll meet them tonight. But that growth from 98 till essentially through Dad, most of it was with institutional capital, and it was finding deals for these institutional partners, whereby Driftwood would source it. They would come in with the majority of capital, and ultimately that was the syndication vehicle, and you would keep the management and then the ultimate back-end promote. So, on the same token, my dad had grown initially with the Friends and Family Network, and that's another traditional model, but it's a much smaller growth trajectory because it's a smaller network, and the way deals are done, with that capital, that has to be funded in advance of a deal, and the deals move quickly, 30 days due diligence, 30 days to close. And so ultimately the ability to scale that is challenging. And so what we came up with was a way in which we could tap into that network of friends and family, but on an expanded scale, on a direct scale to retail investors, to individual investors that have wanted this product, but either have a network that they know and trust or would go through an institution. And that's what we've changed with Driftwood Acquisitions and Development. We wanted to find something in a model that would work for direct investors without having to go that extra step, because ultimately, that is another cut in the deal and in the returns. And it also creates a lot of rules where it's a blind pool portfolio. There's typical timeframes for 5 to 7 years. There's just a lot more controls that the investor, doesn't have the opportunity to decipher. As we've seen since 2012 with the Jobs Act, is a tremendous growth in this, and we're really at the forefront. And that's because, you've seen the rise of platforms, and these platforms, they announce deals, but they're typically not the sponsors of the deals. So what happens, they go out to developers or, other acquisition companies, and they'll say, why don't you list your hotels on our platform? And ultimately, they're just playing that middleman role. For us, we are, a vertically integrated company. We're the ones sponsoring the deals and allowing, with our structure, to have investors come in right at the point of closing the transaction. So it's not a situation where, we necessarily need the capital, and that's why we're going on, a platform, or that we're cashing out of a deal that we've had for many years. This is a situation where we set up a fund that goes out and sources deals with our team, with time, and closes on it, ultimately improving the economics of the transaction, because with our capital in hand, both from the financial institutions to the brokers, they realize that we're ready to close, that we can close quickly. So sellers really appreciate that, because ultimately, it means that they have certainty of closure and they have quick time frames. So with those two components, obviously for us, it means that we can potentially get better deals going in, or better pricing going in to buying the acquisition. So the way we can do that and scale that is by turning around and then syndicating the deal. And this little graphic here shows the potential of institutional accredited investors, which is what this act has allowed us to do, is to mass market to accredited investors directly. And we're the sponsors and also offering this. So, there's a vertical integration. We have this sister management company that we'll talk about the growth in a second. But that is essentially a one-stop shop to access direct commercial real estate, which is, something new and innovative. And so I was talking about the growth of Driftwood management with institutional capitals, and that's really what's allowed the 20-year track record, the 75 plus hotels today, the 5,000 employees, and $3 billion of assets under management. It allows us as the fund to look at every single state, every single type of hospitality asset, and feel comfortable that our management team has the expertise and know how to manage, and it's a constant interaction when we underwrite the deal to have that insider knowledge. Because ultimately, unlike tradition, the entire picture of commercial real estate, hospitality is an operation business. It's a daily lease business, so it has greater potential for upside, but you have to know what you're doing. And that insight of information with the sister management company is very important. And that track record of growth with institutions is something that has really allowed us to scale on the direct investment side. So this is their portfolio of management. We comprise today of 19 of those assets, and a few developments as well. So this is the full picture of landscape of hotels that Driftwood manages for both our assets and for other institutional capital or owners or banks that need the services. This is now talking about just our portfolio within that subsect. And so since 2015, when we implemented this model of acquiring the hotel and then syndicating it direct to accredited investors, we've been able to acquire 19 hotels, 5 developments, $1 billion of assets under management, and the $300 million syndicated to LPs, so to over 600 investors, a lot of you guys here in the room. So we thank you very much for your support and your continued support for this amazing success. So with that, I want to let my dad talk about our portfolio and the performance to date.
Well, this is a map of the United States, and quite frankly, I'm very proud of what we've done in these 4 years since we got started. If you see, we're pretty much all over the United States. You know, we have in the West Coast, we have in the East Coast, in the middle. I mean, we have several projects under development currently. On the development, we have the Element Mission Valley in San Diego. We have the Canopy in Tempe. That one's finishing in the first quarter of this year. We have a Staybridge. There's an office conversion in Delaware. We have True Home 2 in Fort Lauderdale that we're about to open up. Another Element project in Melbourne, and the International Palms in Cocoa Beach. And we've had several hotels all over the country. We have the Hilton Saratoga, DoubleTree St. Augustine, Hilton Cocoa Beach, Crown Plaza, Sheraton Salt Lake City, so on and so forth. So we've accumulated a really good portfolio over the last 4 years. Basically what you see is with the $50 million that we started in our first GP fund, as my son said, we've syndicated to $300 million to limited partners like yourselves to be able to buy this portfolio of $1 billion. And through time, we've grown in the investors. As I said, we started with no investors. We went to 83 investors, and today we're well north of 600 investors. Actually, I think we need to update that figure because we're closer to 700 investors now. And the acquisitions, as I said, we've been to up to 19 hotels now. And the distributions, you know, on average, if you had invested $100,000 in every single one of our hotels, basically, this is the distributions that you would have gotten every year on average, as a simple average. So if you had obtained $100,000 in every single deal, you would have had a 10.7% return the first year, 7.6 the second, 9.8, and 9.2. That only accounts distributions from regular operations. That does not account capital appreciation or debt amortization or the sale of the hotel. For example, Altamont Springs was like a 37% IRR that took place last year. Does not count it. This is just straight distributions to the investors on average if you had invested in the entire portfolio. There's a, a good comparison. It depends on how you measure it. If you have the weighted average of the entire portfolio, the distributions would have been 8.9. If you had a simple average where you invest the exact same amount in every single hotel, you would have gotten 9.2. And it's comparing it to the weighted average of the typical lodging REITs and the typical S&P 500. So this is pure distributions and the results that we've given to our investors as a portfolio versus, REITs and the S&P. Here, I always like to give the scorecard, and I like to recognize, as they say, the good, the bad, and the ugly. I mean, in every portfolio, there's always going to be hotels that exceed our original underwriting and expectations, and there's going to be dogs. I mean, that's just the way it is. But the good thing is, at the end of the day, you like to have an average that is a good average, and that's why I really emphasize every single time an investor comes to me, is I really like to emphasize the fact that, do not invest all the eggs in one single basket. You need to diversify. You really need to look at it, and when you look at your portfolio of investments, you need to, if you have $1 million to invest in hotels, spread it around. Put $100,000 in each hotel and get 10 hotels in it instead of having $1 million in one single hotel. So, these are the hotels that have been above expectations and have been, or at least meeting expectations. The huge home run, obviously, is the Hilton Cocoa Beach. Hilton Cocoa Beach is this year distributed 27.3, and next year is projected to distribute again 24.1. Orlando, the Holiday Inn Express, 16.5. Next year they're building a hotel right in front of us, so we're projecting it to distributions to go a little bit down to 10.8, but it's still exceeding expectations. Park City, again, it's also doing very well, and it's 13.9 and 13.3. Dallas, by the way, the Dallas Hilton, 2 years in a row being #1. We're very proud of that. That's giving very good distributions, and it's also meeting expectations. The Atlanta portfolio has also been exceeding expectations. The Margaritaville in Osage Beach has an amazing future. We feel very good about this hotel, and it's also giving very good distributions. Mission Valley, you know, the numbers there are low, but those are still meeting the underwriting numbers that we gave when we sold it. The same way with Melbourne. Those were the numbers that we were expecting at the time when we underwrote it and when we, you know, basically syndicated to investors. But the average, again, the simple average of these hotels that we've distributed, basically it's a 13% for the year, and we're projecting for 2020 at 12.2% distributions. We acknowledge too that we have some hotels that have not met expectations, and I divide the group in two parts. You know, we have these DoubleTree St. Augustine that is still giving decent distributions to their investors, but we acknowledge and we understand that they're not meeting the expectations that when we underwrote it. Honestly, that was affected by a Embassy Suites on the beach that opened up, and there are some new hotels also that opened up in the downtown area, and that affected us to some degree. But I mean, it's still providing decent returns. It's just not meeting the underwriting expectations we had done. The Hilton Durham, actually, I believe that next year we'll be moving it up to exceeding expectations. This one is a true winner. It's coming up. It had a slow start, it had a slow ramp up, but it's continuing to improve on a regular basis. So the Hilton Durham, you know, will definitely be moving on into the previous sheet versus staying here. Salt Lake City, as you can see, got hurt. The Marriott merger, and we'll look at it in another slide. The Marriott merger affected this hotel a lot. Also, there was a big event in the summer and in the winter that moved out of Salt Lake City, and that affected it. But we're expecting it again to improve returns for next year and improve substantially. So that one also is getting back on track, but it did have a little bit of a slow start. Saratoga, I mean, honestly, it's stable. It's probably going to stay there. It's going to give decent distributions, but never going to meet the expectations we had. There's a union issues there. There's a hotel, you know, new hotels that were built into the market that we're not expecting. You know, competition from Hilton family of flags that were added to it. And that one, you know, while is not terrible, is not going to be the type of hotel that, or meet the type of expectations we had when we bought it and when you underwrote it. And then there's the three problem childs. Frankly speaking, we do have three problem childs that we're working on, and we'll talk more about them. Tyson's Corner, until now, had been giving the right amount of dividends, but again, this one got affected by two things: the merger with Marriott, and also the renovations got a little bit slowed us down. Novi is one that is going to improve. Novi is a story of like the Hilton Durham. I continue to repeat this because we have an amazing team there. The product is beautiful, and quite frankly, I see great future in this one. It was just a very slow start. And the one that continues to give us trouble is Daytona. But again, if you had invested in the entire portfolio, you know, it's one thing. You know, and that's what I advise to people. There's good hotels, there's some hotels that will not perform, but on average, if you look at the returns, we've been giving on average 9–10% returns as a portfolio. One of the things that I want to let you guys know is we take this seriously. We really do value the trust that you guys have put on us, and we don't take it lightly. One of the things that we've done as a result of these hotels not meeting the expectations that we had for them is we basically sat down with our sister company and our partners, and we looked for ways of how we can move forward and improve them. And the things that we've done is starting now, Driftwood Hospitality Management basically is reorganizing itself so that the regionals, the regional director of operations, marketing and sales and revenue management, basically are going to be brand focused. So we're going to have regionals that specialize on Hilton product. We're going to have regionals that specialize on Marriott product, on IHG, and basically that way they can, be more efficient with their time, know better how to manage the reservation systems, and really go deep, dig deep, and understand how to maximize their reservation systems and the loyalty programs and so on and so forth. So that's one of the things that Driftwood has promised us that they're going to start doing, the hospitality management, the management company. And also, along with that, they're basically adding more staff to the point where now the regionals are going to have only 10 hotels per person, per regional. So the regional revenue manager, the regional marketing and sales, and the regional operations, maximum amount of hotels they'll have is 10 hotels, because that way they can dedicate more time to this. And by the same time, we, as I said, we take seriously the trust that you guys put on us. So in the cases of Novi and Daytona, which have severely underperformed, where we are not happy with the results, what we've done is basically cut our fees in half. Both the management company and the asset management fees have been cut in half for the entire year, because we acknowledge the fact that basically we need to do better. And when they say the saying, when it rains, everybody gets wet, and when it's dry, everybody stays dry. We need to share the pain. So we acknowledge it, and we understand, and we need to fix them, and we are fixing them. But I really want to emphasize the fact that as a portfolio, when you look at the entire picture, giving a 9%, 10%, return is a very decent, good return, especially when you compare it with the other, sorts of alternative investments that you may have as a limited partner. So this is a decent return that we have, and we continue obviously to strive to do better. And one of the things, for example, that I give as an example to investors is during the Great Recession, or whatever you want to call it, in 2008, we had a Crown Plaza in Denver. That Crown Plaza in Denver, for 2.5 years, it didn't give dividends. We sold it a few years later, and the internal rate of return to the investors was north of 17% net to them. So the key here in the industry is really about staying power, structuring the deal the right way, having a good management team to take you through the good times or through the bad times and improve on things. And as long as you do that and you're patient, the returns will be there. The hotel industry is a good industry. I mean, at the end of the day, you need to know that when to buy, at what price to buy, you need to buy right. I mean, I think that at the end of the day, the money is made at the beginning when you buy it. If you buy it right and you have staying power, you'll be fine. So my message to you guys is, I don't know, some of you might be in all the hotels, and in which case you've obtained amazing returns. Some of you might have been in the ones that have exceeded expectations, and some may have been unlucky and just picked a couple of the ones that haven't performed so well. But at the end of the day, I still firmly believe in the portfolio that we've bought, and I firmly believe that at the end of the day, everybody will do well. Because we've structured the deals the right way, we purchased them the right way, and we have a good management team in place, and we're taking all the actions that need to be done to fix them. So, some of the issues, and I just want to explain because this is something that everybody needs to understand. For example, I'm using two examples here, the Hilton Saratoga and the Hampton in Daytona. In 2018, when we were looking at them, there was 3 Hiltons in the market in the Hilton Saratoga and 11 hotels in the market. In 2019, 1 year later, 21 hotels in the market, 7 Hilton products. Same for the Hampton. The Hampton, this is in a 10-mile radius. The Hampton Inn had 2 hotels that were a Hilton product and 6 hotels in the market that competed with it. Now you have 14 hotels in the market and 9 Hilton products. So those are the type of challenges that we've had in a couple of the hotels that have not met the expectations that we wanted. But as I said, we're working on it. The other challenge was with the Marriott merger. I mean, if you look at the Sheraton Novi, the one that I really like and I think has a great future, in 2018, when it was just a Starwood product, we only had 4 hotels to share the reservation system with.
In 2019, we have 29 hotels to share the reservation system with. Same goes with the Westin in Tyson's Corner. In 2018, before the merger, 3. 2019, 47. Sheraton Salt Lake City, 2, then 18. We've passed through this, and we're going to be improving going forward. But it definitely was a hiccup that we had to deal with. And now I'll pass it on to my son.
Thank you. So with the backdrop of our portfolio and performance, I think this visual is the way that we all feel about the economy today and where we're seeing things in alignment. It's been an amazing run so far since 2008, 2009. And everybody has been asking us since 2015 actually is when the next recession is coming, right? That's everyone's question all the time about the economy. And everybody has their crystal balls of when. And we're not here to speculate on that. We're just here to react to the current market environments and seeing how we best adapt to this macro issue on the micro side. And what we want to say is a lot of those challenges that we saw, we had seen in the underwriting when we did those deals. I think that they were just a little bit outsized effects. So that was something that I wanted to highlight, that we knew these things were coming. It's just at what impact, sometimes it's impossible to predict the degree, right? Ultimately, that's the challenge that we have, and we've built out a great team. As we mentioned earlier in the video, we have over 30 people now constantly sourcing the best quality deals and making sure on the asset management side that everything is being accounted for. But ultimately, you can't account for everything, and this is what we're facing going ahead. And we have, within this context of slower profitability growth, low unemployment, lower GDP growth, construction labor shortage, political uncertainty. Obviously, we know that every Trump tweet, the markets swing up and down. So this is a volatile time, and there's opportunities to come out and find that micro within that climate and find a good opportunity to buy. And our goal is to underwrite the best expectations. And so that's what we strive to do. And one of the things that affected us beyond where we had expected, obviously, was in the hotel industry specifically, that low unemployment for so long with slower growth has affected total profitability. As you see, this is the percentage of total operating revenue that's coming down to the hotels. And in the last few years, that's tailed down because of those increasing costs. As you can see here in this graphic, the hotel housekeeper is making $12 when, very similar positions in other areas have been generating more. And we're going to continue to see that increase. And we have, ways to mitigate that. Contract labor, that's been a component of our hotels, we're moving away from. We're going in-house. We're controlling that aspect of it. But ultimately, these are hiccups on the horizon. We still think that despite these challenges, even in this current environment, without any drastic change, we have incredible profitability because hotels are at all-time high occupancies and record ADRs. I think one of the challenges continuing to push that rate. One of the things that we've asked ourselves is why haven't we been able to in some industries? There's a lot of different micro reasons, but as a whole, I think that could be something in revenue management that we seek out and the way we earn the customers. I think one of the advantages that we have is that supply growth has relatively been increasing, but been kept in check relative to the spike in the last cycle, and that's thanks to the financial market. So now I'm going to get into the long-term prosperity, and that's why when we talk about buying these deals, every single deal stands on its own, and you can come in for a $50,000 investment in that opportunity with a time horizon that we say, it's 5-year pro forma, but it's flexible, and we're going to find the best time to sell. And so when you look at long term of the industry, it's very positive. And that is just based on the growth in travel and the demand for experiences and connectivity that you see, the amount of planes in the air, the amount of travel internationally of growing economies worldwide that are traveling more to the US. So as you can see here, the expenditures as a percentage of income have continued to grow, and just the amount of travel. So it's outpacing GDP, 5% growth in travel each year. That should be a positive impact for hospitality. One of the other impacts that we had this year for domestic was the strength of the US dollar And I think, that's one of the goals of the Fed, inflation and weakened dollar, which actually helps the industry. So despite the turbulence, even without much changing, we're not as, negative on next year. We actually see some positive growth. Now this slide, what it shows is just the ultimate hits that we had, black swan events that occurred in the economy, and how short-lived they actually were as a respect to, the travel industry and the continued growth and acceleration. So I think it's important to always look at things, when we're buying these assets, again, it's longer hold periods with stable cash flow, and if you have that staying power and that flexibility, we're going to come out ahead. And the question here in the U.S. is usually, when are we going to recover, not if we're going to recover. And a lot of you international related individuals would know that context doesn't necessarily apply to a lot of other countries, which, that's one of the great benefits that we have here. And ultimately, I was talking about the supply. This is showing you in pink here where the hotel supply has gone since the last recession and as the last peak. And as you can see, it's really kind of steadied and tapered off. And that's true from the profitability side, from the growth side. So, while it's a turbulent and difficult time to predict, it's still healthy profits, and it's still a healthy growth of supply that we don't think is too outsized. What we hope is that the cheap credit isn't going to boost this all of a sudden, because that could affect supply. But to date, we haven't yet seen it, thanks to a lot of the underwriting measures that took place after the 2008 recession. I remember then when I worked at L&R, underwritings were, 100, or the leverage was at 100%. Everybody was just cashing out of deals, and so it set a different backdrop. I think everybody did learn from that, and it's still very difficult to eclipse 70% financing. So the one that we have seen shoot up, as you can see, is apartments. I mean, that has been a tremendous rise, and so is warehouse. But hotel, office, and retail is for a specific reason. Retail has just changed the way things go. But for hospitality, that's why we feel like it's different, because we have all of these demand drivers into the future. The physical space of where you stay is still very much needed. It's not going away. You're not going to replace that physical touch with the virtual. And when you talk about, the rise of Airbnb or Airbnb 2.0 with Sonder and all of that, it's just a different product type. And that's something that's important to distinguish, because ultimately the service of the hotel, the common area space, the lobby space, the meeting space, that's not going away. We have to be cognizant of it, especially in certain markets, but ultimately it's not a replacement. It's just another segment of the market. And so for that, the longevity of the industry is very positive. And then the way we see it is technology, while right now it has its pain points. I mean, the amount of apps out there or platforms or software that get pitched to our operating company on a daily basis is incredible. And to know which ones are the right ones or which ones are the ones to implement, that's a challenge. And so, from a guest standpoint also, all we've seen lately is a cost increase from that technology. But ultimately, what we hope and what we expect is that will bring long-term gains, because we are going to be seeing efficiencies as it comes down to sensors in the room for energy, to as much as just the check-in efficiency, so you need less personnel, the efficiencies of the housekeepers with the rooms. There's a lot of different factors as to why technology in the long run will be a very strong positive for what is a very high operating cost business. Additionally, just the cost per customer should be going down, we hope. That's one of the battles with online travel agencies that I'm sure Chris will be talking about shortly. But driving that cost down is what is so important in this hotel, and just the smallest impact can make a giant difference in the profitability and the bottom line returns. So with that context, I leave it again to my dad here to talk about what we're launching.
Yeah, we firmly believe in the hotel industry and its future. We feel very comfortable. It's a very noble industry, and is done very well by us. And as I said from the beginning, no matter when you're buying it, as long as you do the underwriting right, as long as you structure the deal right, you should do fine in the long run. And with that said, we are basically now raised another $200 million of basically of dry powder to be able to continue to grow our company and be able to continue to offer our limited partner investors like yourselves more and more opportunities every day to invest in deals with us. We basically created $125 million that we're putting into, actually this one says 100, but we're going to be doing 125 of acquisitions. This is the typical deal. Oh yeah, and then we're going to be doing another 125 million dedicated to development. Now, the typical deals that from now on we're going to be doing on average is going to be a sweet spot somewhere in the $50 to $100 million, and average deal size is going to be somewhere in development is going to be around $85 million. And on the development side, we're going to continue to do deals with EB5, and we're going to start looking also at deals on the opportunity zones. Let me see. Oops. Sorry. We have a great pipeline that we're very excited on the development side. There's an element that we're doing in Melbourne Beach. I love that market. Melbourne and Cocoa Beach for me are awesome markets with huge, huge potential. So this is a deal that you guys are going to be seeing, that we're going to be syndicating in the near future. We're going to be developing this hotel. I mean, nothing around that area has seen any new hotel for the last 30 years. I mean, all the hotels in that area are 30 years plus old. There's no extended stay on the beach. I think that hotel will be outperforming the market when we do it. For this one, we're already raised some EB5 money. Then in San Diego, we're also next to the Marriott, we're doing another hotel in Mission Valley. And again, nothing in that market has been built in the last 25 years. So again, except for one small boutique hotel, 127 rooms, that is not in a great location. So this one should also do extremely well, and will be syndicated also in the near future. As I mentioned, we're focusing on looking at deals in opportunity zones. I think that presents a great opportunity for you guys as investors, for all the tax benefits that it brings. For those of you that don't know opportunity zones, basically you can grab any capital gains, whether it's from sale of stock or sale of a piece of land or whatever you sold. Any capital gains, you can grab it and roll it over into these investments in opportunity zones. And basically, you can, number one, delay the tax payment of the capital gains for 7 years and increase your tax basis so you pay less at the end of the 7 years. But then, more importantly, if you hold the property for 10 years, you don't pay any capital gains on that particular property at all. So if you hold it for 10 years, basically zero capital gains. So it's a great opportunity for us to basically look for find sites to develop, and we'll be presenting you guys deals like this in the near future. The True Home 2 by Hilton, that one we basically are finishing it. We should be opening in first quarter of next year. We love that hotel. That hotel is basically in the Fat District of Fort Lauderdale. It's the equivalent to a Wynwood here in Miami. It's in a growing area right next to the Brightline station. We've already syndicated a large chunk of it, but we still have to syndicate another $7 million starting in March of next year. I really highly would like for you guys to take a close look at that, because again, it's also a great deal in a great opportunity zone where you can basically roll over your capital gains and delay it for 7 years, and then again at the end of the 10 years you pay zero capital gains. The IRR on this one on a 10-year hold, mind you, is a 14.5% IRR, and the cash on cash that is projected is a 9.9%. And basically the CO is in March of this coming year. So you get a brand new hotel with a great cash flow that is projected, a great IRR, and no capital gains if you hold it for 10 years. So this is a great project that I might, you guys should take a look at. Again, we're going to be syndicating 7 million more of it in March. The next project that we'll be syndicating in the near future is a conversion of an office building that we bought in bankruptcy. We bought it from the bank. And we're grabbing that office building and converting it into a Staybridge Suites. By the way, Chris, I went first to you guys. But anyway, we're converting that one to a Staybridge Suites. And that's also an opportunity zone, and we're also getting a lot of tax credits, of which any investor that joins us will also get benefits on those tax credits and on the opportunity zone benefits. So that one is another one that is coming up in the near future for syndication to limited partners. Then I refer to this one as my baby. This is a Westin in Cocoa Beach. I've been working this one for close now to 4 years. And it's basically 17 acres of beachfront land in Cocoa Beach. Cocoa Beach is an amazing market. I believe in Cocoa Beach and Melbourne tremendously. This market is growing by leaps and bounds. Why? You have NASA and the privatization of the space race and all the rocket launches taking place there. You have the Port Canaveral that is growing by leaps and bounds with all the cruise lines and Disney cruises and everything. Everybody, all the other cruise lines adding, more demand for rooms there. You have the proximity to Orlando. You're only minutes away from Orlando, and Orlando obviously is a growing city. So, and then also you have Disney and all those parks. When anybody from the Midwest, from St. Louis, from Chicago, from Kansas City, that brings their kids to Disney, for example, they also want to go to the beach, and we're the closest beach. So it has a great demand there. Then you have Patrick's Air Force Base, and then you have all the defense industry. So when you add all those components, this is a great deal. I love this deal. And I think that, you guys should take a look at it when we bring it out for syndication in the near future. Then I pass over, again, the bucket to my son, because he's a specialist in the lifestyle hotels.
Again, we're trying to find different segments where we think that, especially for the developments that are longer term, that really fit a need and a niche. And in general, lifestyle hotels we think is definitely a future of hospitality. No frills luxury. It has a component where you're operating an efficient model, but offering a lot more to the guest than just a bed. And it's a unique local experience, infusing food and beverage while not making the guests feel like that they're just at this large corporate hotel. You've seen boutiques. This is now, you take this model, this has now become a hotel branded model, which adds a franchise reservation system. The scores from Hilton on the Canopy, which just launched, have been really well received, and we're building 2 of them. This one's the Hilton Canopy in Tempe, Arizona, that's set to be open in March of this coming year. And we have another one in our backyard here in West Palm Beach that's right off the Brightline station. So I encourage you all to take the amazing Brightline train up there when it opens in February. That one's launching in February 13th. And just to give you a little idea of these hotels, I mean, in that one, it's 150 keys. We have a 6-story glass atrium that's encasing an art installation that is banyan roots coming from the ceiling that is right above the food and beverage restaurant, at least the downstairs component, and that's part of the lobby. And you go from there up to the second level, which has amazing meeting space. And then we have a fitness deck, an area with a transfer lounge, and then a rooftop pool bar that has an amazing art installation and incredible views. And we've been working on the food and beverage component of it. So it's something unique in the market, and every single one is different. This one in Tempe also is, has a very local feel, and it's right across from Arizona State University, one of the largest universities in the United States with a lot of demand drivers. So we feel good about key location, lifestyle hotels, the Canopy, the Hilton product within this boutique context we love. And these are the type of hotels that we're going to be building into the future. And these 2 might even be available for syndication at some point next year or when we refinance. So again, that's kind of a broad breadth of what we've been doing on the development side. acquisitions. It's constant deal flow that we're looking at, and all of our opportunities, they're going onto our internal platform. This is our way to share all of the information and data with our investors. We have a great investor relations team with any questions that they're available at any time. But obviously we understand that people want their information at any time readily available, and that's through our platform. And you get the new offerings via this platform and quite a bit of data. So that's how we help scale and manage all of this, and we'd be happy to talk about that afterwards as well. So with that, I go back to my dad and Chris, and thank you, and we'll be back with a panel later.
Thank you. I want to, today we have the honor of having Chris Nassetta as our keynote speaker, of having Hilton invite me to speak to the executives and staff at Hilton headquarters, where I got to spend some time with Chris and his team. And I must say that I truly enjoyed the experience and the warm welcome that I received during my visit. So I only hope that we have extended to you the same hospitality while here in Miami. Chris is the president and CEO for Hilton. He joined the company in 2007. Previously, Mr. Nassetta, Chris, was president and chief executive officer of Host Hotels and Resorts, a position he held since 2000. He joined Host Hotels Resorts in 1995 as executive vice president and was elected chief operating officer in 1997. Before joining Host Hotels, Mr. Chris co-founded Bailey Capital Corporation in 1991, where he was responsible for operations of the real estate investment and advisory firm. Prior to founding Bailey Capital Corporation, he spent 7 years at Oliver Carr Company, ultimately serving as Chief Development Officer. In this role, he was responsible for all development and related activities for one of the largest commercial real estate companies in Mid-Atlantic region. Chris serves on multiple organizations and multiple boards. And please give a round of applause and welcome to Chris Nassetta. Thank you. Really appreciate it. Please. So, Chris, first of all, again.
Quite a nice introduction.
Well, first of all, thank you for coming. Really, it's a true honor, and I really appreciate it.
It's a real pleasure. We've had, as you can see, a deep and long relationship. And I was saying, although you weren't hearing, I guess, that one of the things we're most proud of at Hilton is the length and breadth and depth of the relationships we have. Most of the business we do here in the United States and around the world are with partners that we've had for many, many years, like Driftwood. That life, as I was trying to say before, whether it's your personal life, your professional life, is all about friendships and partnerships and working together. Ultimately, there, as you went through, there are times where you need to work hard to make things happen when they're not working exactly the way you want. Sometimes they work a lot better than you want. But when you have a great partnership and you approach it the right way, there's always a way through. And so, Carlos, we appreciate you and your team's partnership over these many years.
Well, likewise, we've really enjoyed working with Hilton throughout the years, and the relationship we've had with everybody at Hilton.
That Cocoa Beach feels like it could be a better Hilton than a Westin.
Oh, we can talk.
I mean, it looks so beautiful other than the sign I saw.
Well, I had a few questions here for you to discuss. First of all, is how do you see the hotel industry's future? What are the challenges and opportunities that you see for the industry on a going forward basis?
Well, you and Carlos talked about it a bunch, so I will try not to repeat. I'm a big believer in the industry, not just because I'm in it and running one of the biggest companies in it, but as I travel all around the world, and that's pretty much what I do for a living, is move around the world. I do a lot. Obviously, we have big business in the United States, but big and growing business all around the world. The thing that you see, and you saw it in some of the stats, is that travel and tourism is not just a big industry. Travel and tourism in the world today is about 10% of GDP. It's 1 in 10 jobs, 1 in 5 new jobs. But importantly, it's one of the fastest growing industries on earth globally. It's one of the fastest growing industries in the United States, but that's true to an even greater degree in other parts of the world. So when I look at it, I look at I say to the teams around the world that I work with, I think for the rest of all of our lives, no matter what your age is in this room, you'll be living in a golden age of travel. I mean, if you look at the massive demographic shifts that are going on in terms of growth in middle classes around the world, and not just China and India and and Latin America and Africa and benefiting those regions, but as those people have more disposable income and want to travel, they are going to travel all around the world. They are going to come to the United States of America. If that's where your business is, it is still the #1 most desired destination from every region of the world. And so that is a gargantuan opportunity. The other thing, and I saw it up on one of your slides that you see, and I know it gets sort of attributed to young people, but I would say I think it's people of all ages. People want experiences. And to a larger degree, over the last 5 or 10 years, I think, well, no, maybe it sounded like I had 2 of them working there. To a larger extent, over the last 5, 10, 20 years, I think people are more indexing towards investing their disposable income in experiences instead of things. And that is a massively powerful trend as well. Again, I think young people probably disproportionately, but I think people of all ages are focused on experiences, on human interaction, on human connections, and at the end of the day, that's the business that we're in. So you take a massive growth in middle class, disposable income, they want to see the world, you put it together with people wanting to have more experiences, and it is a golden age of travel. I think for the rest of all of our lives in this room, it's a golden age of travel. Now, there are some headwinds. I hate to talk about it here with all your investors.
Oh,
you guys said it. I said,
please.
Carlos, do you want me to be honest with everybody?
I do.
But as he knows, that's the only way I know how to do it. There are some headwinds, and you saw some of them. In my mind, both in the U.S., some of these apply more to other parts of the world, but they apply generally on a global basis. Labor, okay? Mm-hmm. Labor's tough, right? Here in the U.S., it's just tough to find enough labor. We could talk for a long time about immigration reform and other things, but there are things that need to happen structurally in the environment here in the United States to help us on that front, or we're going to increasingly have in a low unemployment environment where fewer people want the jobs that we need to deliver those experiences, it will inhibit our growth. Other parts of the world, which I won't spend a lot of time on because I think that this is largely a domestic oriented crowd in terms of the investments, but around the world it's less that there isn't enough labor, it's that the labor that isn't trained to do what we do. And so we don't have hotel schools and all, don't have many of the academic benefits that we have here, and so we spend a lot of time basically trying to teach life skills and basic training so that there are a lot of people, but we can train the people to be able to do what we do. Security, is a big issue. Here's the thing, we know people don't go places they don't feel safe. Okay, so you would think, well, gosh, that's not that big a deal in the United States, and it's not compared to other parts of the world, much more dramatic issues in other parts of the world. But let me tell you why it is an issue here in the United States. I just looked at all of the research on it. What happens outside the United States is all of the gun violence, and I'm not being political, but all the gun violence that occurs here that is really not unique, but relatively unique to this market gets really played on in local press in other parts of the world. So when people are watching their local news station and they hear about gun violence in the United States, they're a little less likely to want to come here. That's not good. It's not a major contributor to why inbound travel is down, but it is a minor contributor to that. In terms of other headwinds, I think the geopolitical situation, populism, nationalism, those aren't good, right? I mean, you want borders open, you don't want borders closed. It's that simple. When borders close, people don't leave, they don't travel, they can't see the world because it it is more difficult. And then the last, and then I'll circle back, I swear I'll be positive, Carlos. The last is one that we can do something about is the environmental issues. Whether you know, and I know there's lots of raging debate about global warming, and so I won't get into the debate. I believe we are impacting the environment, but it doesn't matter what I believe, because even if you don't believe that we are, our industry, like many others, but we're a huge contributor to energy, usage, carbon output, water usage, waste output. Just think about what happens to make all this happen. Our industry contributes to all of those things, and we have to be really responsible with it, because here's the thing: it's having less here, but I see it in other parts of the world, particularly in Europe. Governments are getting much more focused on this, and if we're not responsible about it, they will start to regulate in ways that inhibit the freedom to travel. I mean, if you're paying attention in Europe right now, there's this thing called flight shaming, where people are basically saying, they are making it a bad thing for people to fly, take, short haul trips around Europe because it's bad for the environment. Well, that's not helping the airlines, but guess what? How do the people get to our hotels, right? They get there on a plane, so it's not helping us. So there's a whole bunch of risks associated with that. Those are manageable, okay? I mean, I think they're all manageable. The environmental risks are just, we need to be sensible. I chair the World Travel and Tourism Council, which is the global organization for travel and tourism, and that is one of our #1 priorities, is organizing the industry to make sure that we're all being responsible. At Hilton, we have had huge number of initiatives, as you know, because you as a franchisee help us with those in terms of having our environmental impact, doubling our social impact investing. We are doing amazing things all over the world. But here's the thing: there's some things to compete on, some not to compete on, and this is one, my view is we don't. So what I've been trying to do in my role in WTTC is organize the whole travel and tourism ecosystem to figure out how do we do more, how do we come together, set goals, share best practices, so that we're responsible, so that we do it to ourselves instead of governments doing it to us. Ending on the positive, all of those things are manageable, right? There's no business on earth that doesn't have a few challenges. The undercurrent of what's going on, as I said, is a golden age of travel for the rest of our lives. I raise these other things just because they're things in every case that we can manage if we're intelligent about it, if we work together as an industry, so that we're able to optimize the underlying fundamental opportunity, which is spectacular.
I couldn't agree with you more. Now, if you're one of our investors sitting here in this room, what would your advice be to them? Would you buy and invest more in hotels?
Carlos told me he was going to ask me this, and I said, all right, do you want me to be honest? Do you have all of your investors here? You don't even know what I'm going to say, because he didn't ask me what my answer was. And to his credit, he said, of course, you all know him. I want you to be honest, and I would always be honest. So it really didn't matter if I was going to tell the truth, MARRIOTT. So I said, here would be my honest answer about this. I have a lot of kids. I have 6 daughters, and so I shouldn't say to the women in the room. My wife went through a lot of pregnancies, and I was there, being as supportive as I could be, but obviously not doing the hardest part of it. But I went through very close proximity 6 pregnancies. So I think of life, I was trained to think of life in trimesters. And so I think of investing in hotels in trimesters. Right now I run one of the biggest hotel brand companies in the world, but as you heard in my background, I spent the earlier parts of my career running the largest hotel owner in the world. So this is what I did, and all I did, for not the majority of my career anymore, because I've been doing this a fairly long time, but for half of my career. Or more. So I think about it in trimesters. I think about investing in hotels. We live in a world where you have business cycles. My view is whoever says that this is different and there is no cycle, I think is wrong. I would use a stronger word, but it's late at night, and I think they're wrong. I think what goes up comes down. You will have recessions. I'll talk about where I think we are in a moment, but in hotel investing, in a really oversimplistic way, I think, in the first trimester, you can buy anything that's half decent quality, and you're going to look good, no matter how smart you are, because it's a cyclical business. When you go through a recession, it gets hurt. When you're in the first trimester of a recovery, everything looks good. When you're in the second trimester, I would say you have to be a little bit more careful because, you know, not everything is as good. You're deeper into the recovery. And when you're in the third trimester, you got to be really, really careful. I would argue we're in the third trimester. Like, I don't, by the way, I don't know. Everybody in the room would have a view. I am not of the mind, not that I'm an economist, but we have a lot of sight lines into what's going on in the U.S. economy through our business and the global economy. I think the economy is going to be weaker than it has been in going into the next year or two, but I don't believe it'll be recessionary. I don't think you have the indices of a recession with the lowest unemployment rate in modern history, wage growth that is strong, corporate balance sheets that are strong, a housing market that is strong. I could keep going. I do not think it does not feel like you're on the precipice, but it is weaker. I'm seeing it in our business. We're a great index for the U.S. economy because we have thousands of hotels, every single market in the United States. It is getting weaker. It's not going negative, but it is getting weaker. So I think that we're somewhere in that third trimester, not at the very end of it, but somewhere in it. So I think, to my earlier comment, I think you got to be very, very careful. Now and I'm not just doing this because I'm here with Carlos, here's where who you invest with matters, right? All right, if you believe we're in the third trimester, by the way, if you're in the first or second, this holds true, you want to invest with the people that really know what they're doing. Because here's what I'd say, in my experience investing in hotels literally since I was a kid, because my father and uncle are developers and invested and developed hotels, you can make money at any point in the cycle. In fact, I've made some of the best investments I've ever made in my career in the third trimester, or in the depths of a recession where there's fear and pricing is very attractive. What you want to be doing is investing with people that are thoughtful, that are disciplined, that understand not just the industry, but understand the micro markets that they're investing in, and understand value creation, okay? Not every opportunity that we all look at has what I would call a seam, sort of a unique opportunity to create value that somebody has not seen. But a lot of them do, because there are, like any industry on earth, some people are just better at this than others. Now, the reason you're all sitting here, the reason there's 600 people instead of 80 or 100 is because you guys have done a great job. These guys who we work with all over the country, as you could see those seams, right? I mean, we all have better and worse investments, but on average, a great track record because they know the industry, they know the micro markets they're investing in, they're super disciplined and diligent about how they underwrite, and they find the unique value proposition within the assets that they're buying. And if they don't see it, presumably you don't invest. So I think it's a perfectly fine time to invest in a very intelligent, disciplined, cautious way.
Well, thank you for the pitch.
Yeah. He did, and he didn't even ask me to do that. But I mean it. I mean, we work with thousands of partners. There's a reason I'm here tonight. Not all, it's like my children. I love all my children. Okay, I love all my partners, but some are better at this than others, and you guys are very good at it.
Thank you very much. How about building new hotels? Will you be building new hotels at this stage of the game?
I would. Same answer.
I
would. I mean, we have a bunch of things that, across a broad array of brands, including with you, the two canopies. I would build those all day long. Those are a unique brand, unique value proposition, unique operating model that drives high margins in spectacular infill locations that are incredibly hard to duplicate with great design and great operations. Like those canopies are gonna crush it, even in an environment that is definitely getting a bit weaker. So I think, again, yes, I would develop very cautiously, like the best locations, the best brands. The seams in the development area are about finding the seams where you have a unique product in a unique location. And you know, and those are hard to find. You guys obviously have done a good job finding them. But yes, I would do it very selectively. Now, supply demand, we talked about it. I think we're going to have Smith Travel folks talk about it. But I mean, reality is, even though when you looked at the chart, you know, more supply in industrial and apartments for a whole bunch of secular reasons, less supply in hotels and otherwise. And while supply looks like it's getting back on an absolute basis to similar levels to the prior peak, the reality is, as a percentage of the installed base, it's much, much lower. I mean, this year we're going to have 1.9, in the United States of America, we'll have 1.9% supply growth. I hope the Smith Travel guys are going to agree with me on this stuff. It's what Amanda told me last week. And that is generally consistent with the 30-year average. Supply, when it has gotten to be a problem, okay, no supply is always better. It's laws of economics are alive and well, right? If you had zero, it would be better, more, you know, high demand, no supply. But 2% is effectively what you've had as a 30-year average, where you've had problems where you've had supply-led issues in the industry. It's been 4, 5, 6. I can remember cycles of 6 to 8%. So reality is, from a development point of view, we do not have, there are some exceptions, micro markets that have oversupply, but broadly in the United States, you do not have a supply issue. That is not our issue right now. You have demand weakening a bit, and so you just have to be careful about where the broader economy is going.
Now, what do you think of, there's some fears in the industry as to brand proliferation. Thank you.
I messed that up.
And the dilutive effect it has on the reservation systems, on the loyalty programs. Do you think that there's a brand saturation at this stage, or do you think there's still room for more brands? What are your thoughts on that?
I think we're getting close. I think we're getting. I mean, I'll speak to us, and then I won't be critical of all of our competitors. Of course, they have too many. I'll just say it. But kidding aside, we go through a really rigorous process, as you would hope and think we would when we think about launching brands. It's not like, hey, we got an idea, it's not willy-nilly. We do a huge amount of research to understand what our existing customer base wants, what our customer base that we're trying to attract that we don't have wants, and whether we think that it has enough of an individual swim lane, meaning that it is not going to cannibalize other brands that we already have that exist. And so all of the brands we've launched, we believe, that there is enough demand to not just satisfy the return requirements, but to drive outsized returns, to drive market share premiums. And I can honestly say, I mean, there are individual cases, within the brand where it's not the case, but on average, every one of our brands is either the category killer in its segment or the co-leader. I mean, we have the market, on average, the highest average market share in the industry in every individual brand. I'm not trying to brag, that's why we work together in part. I hope that's not just that we're witty and charming, but you want to make money too for your investors. But I say that because that's what we want. We don't want anything. We're not going to ever launch a brand that we think is not going to be able to drive enough demand to be a leader within its segment. Now, is there overlap? Is there friction around the edges? Occasionally, yes, In our case, when we look at market share, we think it's testament to the fact that there's not a lot of friction. But I'd say, I've been at the company 12 years. We've added, 9 brands. So you would say a lot of brands. They're all working. The market share of them is great. I think we're sort of at the end of the run. I mean, we had a bunch of gaps when I got there. We established most of the gaps early when I got there, and we said we want to take our time because we want to give them each a proper launch. Even if we know we need and want something in that segment and our customers want it, we don't want to rush them to market. Rationally, I think there's probably 1 or 2 more segments that would give us, sort of 19 brands. And we think, unless something radical changes, something changes radically with what our customers' needs are, I think that's it. Now, I'm not going to pick on competitors. I think some probably do have too many. There is not just friction. There's a significant amount of overlap, and I think that becomes problematic. We do not believe we have any of those issues. We have a little bit of friction around the edges, not a lot of overlap. And the major difference in us and them, and this is all publicly available through those guys, through the Smith Travel guys, is back to what I said, all of our brands work. Now that doesn't mean an individual asset doesn't have an issue in an individual market, and in those cases we need to work on that. But across the United States, across broadly all the brands, they all work. But we're going to take a break. I mean, I've said to our team, we're launching a mid-scale lifestyle brand in the next couple months that we've been working on. That's pretty well known. I know you guys know about it, and then I think we'll take a break.
So, of all the Hilton brands, which one gives you the highest ROI?
I thought you were going to say which is my favorite. It's like my children; they're all my babies. I can't have a favorite. I think if you look at it historically and objectively, I think it's Hampton. I mean, sadly, I want to talk to you about the one that I saw up here to figure out what the heck's going on. But the Hampton brand, I would say, objectively, if you look at market share, if you look at profitability, system-wide profitability, customer satisfaction, existing base, the pipeline. I would say it's the best brand in the world. I mean, at least as far as I can tell, on if you put all of those metrics together, and if you look at, I don't know the returns everybody has. They don't disclose it, but if we have a pretty good perspective on it, just because we have so many long-standing partners. I think on average, people probably have had the highest and most consistent ROIs on that brand.
Now, changing topics a little bit.
And True, by the way, which is new, was sort of designed at a lower price point to deliver something very, very similar, which is, new build. I mean, we engineered those brands to be able to deliver a return on total cost stabilized of 12% or better. And that, in today's world, which is not just low interest rate, I mean, go around the world, it's negative interest rate environment, being able to get a 12% return when yields around the world are zero or negative. Those are nice. Those are nice returns, and the ones you're delivering are really nice. 10 or 11 is really, really nice too.
We're very excited for the True Home 2 that we're opening in the near future. Yeah. We're very excited for that one.
It's a great combination too.
Now, one of the questions that I constantly get repeatedly from all investors, and whenever I go anywhere and give a presentation, probably one of the first questions I get is Airbnb. The famous Saunter or Airbnb, and what's the effect of Airbnb?
I've never been asked. That's shocking. I can't believe you get asked that often.
So what do you think of the effect of Airbnb?
There's nowhere I go where I don't get asked this question. And I've had to change my answer just to make it interesting to me, because I have to answer it so often. Every investor, it doesn't happen on every earnings call anymore, but it used to. So we've done a huge amount of work on Airbnb and the sharing economy broadly in our space, and we continue to do work because I think it's moving. It's funny, we talk about Airbnb everywhere we go now, but if you went back 5 years ago, even probably 6, nobody even knew what it was, right? So it's like it wasn't even a thing, and now it's a thing. And so I think to assume we have figured it all out would be naive. Is part of my point. Having said that, we've done a huge amount of work. We've talked to them a lot, to understand their strategy over time, to understand whether there's any points of connectivity. We've talked to our customer base. We've talked at all ages. We've talked to folks that aren't our customers but are their customers. I have sat personally in the room for dozens of hours behind one-way mirrors listening to focus groups. I have led personally dozens of focus groups with people who have no clue who I am and who I work for. To listen, again, people of all ages, and we use our own people of all ages, including a lot of our young people. And here's what they say. Okay, let me skip to the answer, and I'll fill in the blanks. It's not something we should worry about, okay? Because what we do is something very, very different. What we do, okay, if we do it right, is we take a product, that is You know, it has all the functionality that people need, you know, the rooms, the bathrooms, food and beverage at whatever level, public spaces, meeting spaces. We put it all together in a way that you know, technology that gives them the functionality that they want. We do it in a really consistent way that they can rely on, and we wrap it in authentic. So if we do it right, we wrap it in great service, right? So we have product, amenities, service, all wrapped together. And what do? They pay us a big premium, right? At Hilton, on average, we get across the whole world a 15% premium to the competition. Why? We do it better, okay? We do it, we have better products, more consistent products, better service delivery, right? So they pay, we're the premium player, right? And that's what we want to be, right? The world is littered, the streets are littered with companies that become the discount player or the commodity players that eventually get eaten alive. We want, our whole objective at Hilton is to be the premium player, right? And in the world that we just talked about where more people want to travel, more people want experiences, our customers say they want not just experience, they want better experiences. They want more service. They want better service. They want more consistency. If we just finished a body of work for 9 months, I know this is a long answer, but it's an important one. We did with all customers, and what they said, we've asked them about Airbnb, what they said is we want 3 things from you, and only 3 things. We want a reliable, friendly, and memorable experience. And if you do those things really, really well, we'll pay you a big premium, okay? So now back to Airbnb, what is that? It's none of those things, by definition. It's not that it's bad, it's none of those things. It's a entirely inconsistent product, functionality that is wildly different in every location, no amenities really to speak of, and limited or no service, okay? And so it is the antithesis. So what is it? Why do people use it? You know, I'm not saying it's a bad business, it's just a different business. Why people use it, and when I sit behind the mirrors or do the focus groups, it is typically leisure-oriented, longer stay, higher occupancy, and value proposition, right? They don't want to pay the premium price because they can't afford it, or they don't want it because they need a kitchen, they need to have 5-7 people stuffed in it, you know, they're going to be there for a weekend. Every single time, almost unanimously, at all age groups, if you ask people what they would prefer what we do. But when they're looking for a particular value proposition, they prefer that. So I say to our team all the time, the fastest way you can screw up the business is forget the business you're in. We're a business of doing what I said, premium products, premium service, people serving people. So the best way to insulate ourselves against Airbnb is to be great hospitality companies. And my view is, as supported by a huge body of work, customers want that, and they will pay a premium for that, and I don't think that will change.
You know, Hilton, to me, is the gold standard, I mean, in the hotel industry. It really is, and I'm not saying it because you're here.
That's nice. See, I said all those nice things about you, now I get
no, but it's
reciprocity.
True. It's true. I mean, you guys are the gold standard. So, with that said, to what do you attribute Hilton's success and the growth and the trajectory, and where do you see Hilton going from here?
The answer is one word, but you know I can't do anything in short form. But I'll do it and then I'll fill in the blanks. Culture. We're celebrating our 100th anniversary this year. In May of this year, and we've decided we'd celebrate the whole year, it turns out. But if you go back to the origins of our company, we've spent a lot of time going back to understand the founding principles of our company because it's our 100th. Conrad Hilton founded this company 100 years ago on a very noble premise that he thought he could make the world a better place. He thought that by allowing people a safe, secure place with product that was consistent, wrapped in heartfelt, authentic service, he would create an ecosystem where people would feel comfortable traveling around the world, which would allow for a greater exchange of cultural exchange and understanding that would lead, in his mind, and he said it famously many times, would help lead to more world peace. That's how the company was founded, was like a purpose. Like, he wanted to make the world a better place. And so if you say, like, why are we successful to this day? that we continue, not throughout the whole 100 years. I think we lost our way for some period of time during that, but I can say certainly in the last 12, what we have done and what we will continue to do for time and eternity is ground ourselves back in the founding purpose of the company, that we are not here to fill beds, we're here to deliver incredible experiences and to make the world a little bit better place. And so we have built a culture that really, I believe, empowers people, inspires people all over the world to feel part of something much bigger than themselves. And so what does that translate into? That translates into them just giving that little bit of extra effort, right? That little bit of extra effort in their job, whatever they do, that little bit of extra effort with the customers, that just a little bit making sure that everything is just right when we are delivering these experiences. And that's what we've been doing for 100 years. And so if the book were, the book has been written, there have been plenty of books written, but certainly in my tenure here, I would say, and it will continue to be as long as I'm around, and hopefully indefinitely, it's been the culture of the company. It's the people of the company being focused on something, being part of something bigger, people serving people, and that translating into something that matters, so that when you walk into a Hilton, it feels a little bit different than when you go into other places. Now, it's a complex equation, right? Because they're not all our people. I get asked this all the time. A lot of them are your people, right? They don't even work for us. Half our workforce in theory works in a franchise environment, half of them work for us. So we have to figure out ways to get your teams to feel like, whether it's in a Hampton or a Hilton or a DoubleTree or whatever, or a Home2 or a Canopy, that they're enough part of our ecosystem where being part of Hilton and being part of that founding purpose, if you will, matters to them. And that's hard, but I think, we work hard at it. I think we do a reasonably good job of it. We can always do better, and part of that is back to you. Part of that is picking great partners that are proud to be affiliated with us and that actually take some pride in being part of that purpose.
I'm dating myself now, but I remember when I first went to one of the first Hilton conferences that I ever attended to with my wife Pam.
What year was that?
Oh, this is a while back, so I don't even want to say what year. But,
okay, I wasn't around.
No, you were not around.
I was alive.
You were not around, that's for sure. But but I can tell you that back then, the amount of franchisees that attended that particular meeting could have fit in this room. I mean, I'm telling you.
Not possible anymore. Yeah.
Now it's unbelievable the growth that Hilton has had. I mean, now
Well, we have to break it apart. If we put it would take a sports stadium.
Yes.
We have 10,000 owners now.
Oh, I know. It's incredible. It really has been incredible.
2,000 or 3,000.
And quite frankly, it's really due to the culture that you said, and not that Matt is here. I don't know where's Matt.
He's at the bar, probably.
But you have a great development team. You really do.
You
really do. From Bill, Matt, John, Glenn, the whole team.
Real
good
people.
Team.
I mean, we understand, as I said, that
awesome to work with.
It's not wit and charm that in the end is going to keep you coming back. Because we got to deliver results, right? We got to deliver market share. We got to allow you to deliver returns to these fine ladies and gentlemen that are in the room. But that doesn't mean you can't have wit and charm, and I don't mean it that way. But I mean, we work really hard with all of our partners to be good partners. I mean, I said I grew up on your side of the business. I grew up on the ownership side of the business. One of the things I'll say that frustrated me to no end, because I was the biggest owner for most of the big brands, ironically not for Hilton, but every other of the big brands, that we were, we were sort of a necessary evil rather than partners. And so one of the things I said when I got here 12 years ago is like, that is crazy. I mean, certainly customers are, that are staying in the hotels are critically important or we don't succeed, but our owner community are our customers. They're our partners. None of the opportunities we have to do what we do are possible without you all. And we need to sort of treat the relationship that way. And the good news is that I think Hilton had really good DNA in that regard even before I got there, and I think we've tried to push really hard to be thoughtful, deliver returns, but be flexible and thoughtful, and when things aren't right, figure out how to make them right.
And one last question. So what would be your parting words and advice to all of our investors here tonight with us?
Gosh, I don't know. I gave all the good advice I have. It's good. I would just say thank you all for putting up with me and this on this fine evening, staying away from that beautiful bar that I could see through the window that I'm sure is beckoning everybody for a little bit later. It's fabulous. I did get a chance to talk to a few people on the way, and hopefully I'll hang around a little bit. And anybody has any questions, I'm happy to answer them. Again, my parting words of advice are, it's a great business. It really is. I've made a career out of it. I'll never leave it. There's crazy good opportunities in it. Pick your partners well, and in this case, I think you have. And make sure your partners pick their brands well.
Well, Chris, a true honor. Thank you so much. I appreciate it. Thank you. It was phenomenal. Thank you. A true honor to have you here. Thank you. And now I want to welcome Robert Bowers from STR. Please come and take over the mic and give us your presentation.
Thank you, Carlos. How do you follow that?
The mic don't work.
It's not on? I don't know. Let's see there. What about that? Is that better? No? No? Is that okay? Hello. I'll try this. How about that? Well, thank you guys for the opportunity to be here. It is a privilege and an honor. What we're going to try to do today is really kind of give you a little bit of an idea about what's going on in the industry. You've heard a lot from Chris, you've heard a lot from Carlos, and you'll hear the same type of things from me, I think, too. And we'll also kind of take a look at where we think things are headed into 2020 and beyond that. So, for the first 10 months of the year, these are kind of the key KPIs here. RevPAR growth at 0.8%, just under 1%. We just processed preliminary numbers for the month of November, and the month of November RevPAR growth was actually 0.8%. So we're probably going to wind up the year, 2019, you will see that in the forecast that we have, but probably just under 1% in terms of RevPAR growth for the industry as a whole. Like Chris said, the long-term supply growth number in the industry is 2%, and that's essentially where we are now. You can see that the demand number is just below that. Demand growth is just below that, so that means that occupancy is a little bit negative, and I think as we move into next year, we're going to continue to see that as we go. This is kind of a look at the 12-month moving average, kind of the longer-term look at occupancy growth. That's the blue line there. Excuse me, that's the green line there. So, yeah, that's because it looks like the legend on the chart here is flipped. Actually, occupancy is the green line. It's the kind of line there that you see is flat. You've seen it's been bounced like from 2017 on. It's gone up a little bit, but it's kind of bounced down now, and it's about flat. And you see that rate growth has been kind of on that slow trajectory, slowing to around 1% or so now. As we heard before, a lot of the questions that people are talking about is, where are we in the cycle, and how much longer will the cycle continue to be positive? We are now 9 years into a positive RevPAR growth. This is RevPAR on a 12-month moving average, and as you can see, it's just under 1%. By the end of the year, we will eclipse the longest growth spurt that we've ever seen from 92 to 2001. That was about 9.5 years. So in the cycle that we're in right now, I think that we're going to see that eclipse the cycle that we tracked back in the 90s and through 2001. So if you look at kind of how it breaks down by the markets, if you look at the top 25 markets in the U.S., there's really more supply growth there, and RevPAR growth is actually a little bit more negative because of that supply growth. But what we've done here is essentially kind of break out the top 5 markets in terms of RevPAR growth and the bottom 5, and some of the reasons for that. So I think the point that you want to take away from this is that when you look at the numbers for the industry as a whole, you really have to kind of get down into them and look at specific markets. And like Carlos said and Chris said too, it's really dependent on individual markets and individual deals, because if you look at where supply growth is right now, about 10 markets in the U.S. account for about a third of the supply growth as a whole. I think this is an interesting graphic to look at because we've all talked about it and you've heard about it, and we all know that right now unemployment is at historic lows. So what you can see here is this is kind of a graphic that looks at the growth in labor cost per available room. That's in that like blue column there. And then this is total revenue growth, and that's in the green line there. So for the last 3 years, 16, 17, and 18, those are really the only years that labor cost has eclipsed revenue growth. And then if we kind of go back and we look at when the economy was in a down cycle, you can see that labor cost tends to go down, but revenue tends to go down more. And as Chris said, I don't think that we are headed for a recession in 2020. I don't think that's going to happen in 21, but it will happen at some point. So just to kind of keep this in the back of your mind and be aware of it. In terms of the chain scales, what we do at STR is essentially we break the brands down into what we call these chain scale segments. This is just kind of an example of some of the brands, not all of the brands, but some of the brands that are included in the chain scale groups. If you look at this, again, this is year-to-date supply-demand growth by chain scale, and that blue column there is growth in supply, and that green column is showing growth in demand or rooms sold. And really what you see across the board is supply growth across all of the chain scale groups is eclipsing demand growth. And that just means that occupancies across all of the chain scale groups are down. If you look at where the supply is coming, the upscale and the upper mid-scale brands, really those types of brands have accounted for about 2/3 of new supply growth. That's been that way for the past 7 or 8 years, and that's going to continue to be that way as we roll into 2020 and beyond that. This is looking at chain scale in terms of occupancy change in the green and ADR change in the blue. And again, just like I was talking about before, you can see that movement that we've had, positive movement that we've had, has come essentially from ADR growth. Occupancies are basically flat to down with the exception of the economy segment. And really what's happening there is a lot of the supply and economy, there's not a lot of development in that economy chain scale group, and a lot of the supply is converting out of there. So essentially what that means is supply has actually decreased in that chain scale group. In terms of the pipeline, that's one of the things that we really kind of know a lot about in terms of what to expect and where we think things are headed in terms of supply growth. Like we see right now, we're about 6,000 rooms below the prior peak that we had back in 2007. But as Chris said, over that length of time, the base of supply has increased pretty significantly. So I don't think from an industry-wide perspective, we're in any kind of danger of any kind of huge supply spike or anything like that. Specific markets, New York is one of them, Nashville is one of them. There are specific markets where supply growth will be an issue, but you have to kind of look at those individually as you plan your year. In terms of the forecast, like we were talking about, we think from what the economists tell us that the economy is going to continue to grow. The forecast for real gross domestic product growth is about 1.6%, down from over 2%. So I think most of the people that are looking at the economy that really know it, they believe that we are going to continue to see growth. It's just going to be a little bit slower. And the way that that translates in, if you look at the forecast for 2019, as I talked about before, we've only got one more month. We will probably end up at just under 1% RevPAR growth. Into 2020, we believe that you're going to continue to see RevPAR grow just a little bit slower. And then as we move into 21, a little bit of an uptick there. But like we were talking about before, no real huge spike in supply growth. Demand growth kind of hanging around there at about just under 2% or so. So occupancy's still kind of flat to down. And in terms of how that translates into the chain scale groups, this is a look at the forecast for 2020. And as you can see, the way that we see it now is a little bit more growth in terms of RevPAR at the top end of the market for luxury hotels, upper upscale. Everybody there at about 1 to 1.5% or just a little bit flat. And if you look at upscale and the upper mid-scale group, if you look at kind of that flattish to down RevPAR, a lot of that is due to that fact that that's just where a lot of the new supply is going to come. And really, I mean, I think a lot of the things that I have here in terms of top-of-mind thoughts, we've kind of gone over this before, but I mean, I think the things that you really want to keep in the top of your mind is what's going on in the economy, because it seems like that seems to change each day in terms of you know, the news that you get. We've talked about the fact that, you know, it's always been important to attract and maintain the best employees around, because that gives you a competitive advantage. That's hard to do, but especially now, it's really, really important that you do it. I think from an investment standpoint, you know, you're going to continue to see this low interest rate environment as we move into 2020. Like we were talking about, continued supply growth, but from an industry perspective, not a huge spike. Specific markets, yeah, it will be a challenge. And then like we talked about, I think from, you know, the first slide, a little bit slower growth in RevPAR. So with that, Carlos, I will, I guess, turn it back over to you.
I had turned off the mic so that I can speak. Now we have the panel that my son will be running and asking the questions of several distinguished guests that we have invited to join us.
So thank you all for making it through all of these presentations. We promise we'll be brief, and we have an amazing cocktail reception and dinner after. We'll try to keep it lively and fun. We've got a great panel. I want them all to come up here on stage. Good mix of industry veterans and friends and from different sectors of the industry that we're very proud to have here with us again. Oh, good. There's another chair now I can sit down. You can take this. Well, I wanted to go around and have you guys introduce yourselves directly. So why don't we start with you, Matt?
Okay. There we go. My name is Matt Whaling. I'm the Senior Vice President of Development for U.S. and Canada, and I oversee the growth, net unit growth for all of our brands except for the luxury brands. So, it's a pleasure to be here with you all.
See if this one's good. I'm Kellen Florio. I'm a managing director and the global head of lodging and leisure at Goldman Sachs. I cover all the public and private corporates and tend to work on more corporate-related transactions in the broader hospitality space, mergers and acquisitions, IPOs, financing, and generally access to the capital markets for folks in those industries. Been a pleasure to get to know the Driftwood guys over the years. Within our bank, we've done a lot of work with them, both on the mortgage finance side and just kind of broader, bigger picture strategic ideas.
I'm Teague Hunter. I don't know if that works or not. I'm going to try it. I can speak loud. I'm President and CEO of Hunter Hotel Advisors. We're hotel brokers. We do hotels. We don't do anything else. So we specialize. There's a reason for that. We have offices in Miami, LA, Dallas, DC. I'm in Atlanta. So we cover hotels across the country.
All right, Rich Highfield. I don't know if this is on, but I'll say it loud. Starwood Mortgage Capital, not Starwood Capital. Two different, entirely different sort of entities. But Starwood Mortgage Capital, I'm president of Starwood Mortgage Capital. Do CMBS financing. For those of you not familiar, that's the long-term, non-recourse, fixed-rate financing. And we've financed, I think, only the winners on this sheet so far, right? Anyway, we've done a bunch with Carlos and team, so happy to be here.
Well, thank you all for being here. I've had the pleasure of knowing all of you and working with all of you. And I want to start with we've talked a lot about hotels, and I want to start with just the commercial real estate industry as a whole. And I think, Rich, obviously in commercial mortgage, you're very well suited for this question, and Kellen as well. Obviously, you're seeing lodging, but in the public market sector. So I want to know what are you most optimistic about on the commercial real estate side as a whole? Rich, why don't we start again?
I'll say, it's optimistic, like a really good dose of like caffeine and things like that. But rates being this low, anybody in this business has benefited from it, and it's sort of loosened the collar for a lot of deals in terms of, thresholds when you have a debt service or your loan payments that are so much lower by virtue of low rates. You have a little more breathing room. And cushion often to absorb the downturns or just the dips, the ebbs and flows, a bad month, things like that. So that's been a big, I think, a reason for optimism or enthusiasm. The other thing is, oddly, I think the constraint or discipline around supply in most of these markets has prolonged this cycle, if you will. So it gives us more confidence lending in a lot of these environments and a lot of these different properties and markets.
Sure, and from my perspective, I think one of the things that we're optimistic about, I think it dovetails from the rate side, and that is because of the low interest rate environment and the sustained economic recovery we've had, there's been a tremendous amount of growth in certain particular asset classes as well that's attracted really unique forms of capital, everything from opportunistic to core plus, and even long-dated capital in a REIT structure in the private and public markets. And so we've seen this tremendous influx of capital into the broader commercial real estate landscape that's enabling owners to do interesting and innovative things. And so in the highest growth markets in the REIT markets that we've seen in the past couple of years are industries that didn't really exist in an institutionalized platform format a decade ago. So data centers being one of them, industrial REITs, the warehouse space, and single family rentals. So again, just really innovative capital coming into the markets, sustaining valuations and activity.
Appreciate that. Now from the hotel side, we obviously heard from Chris. I'd love to hear from you, Matt. What is the most exciting industry game changer that you're working on at Hilton?
Well, and hopefully I don't duplicate too much of what Chris said, but I would have to say it's the new brands that we have come out with or are currently working on. If you look at the landscape of hotels that we have had, and you look at the brands that we've added, they've been truly dynamic and have really hit the market running each time we've done it. Chris did mention we take a very deliberate approach to launching a brand, and we look just at white spaces that we have. We work with owners that share with us certain markets or niches that they believe we might want to hit a brand in. We talk to our customers. And then we do a lengthy analysis in order to come up with the appropriate brand for a particular market segment. And I would say again, with the success of the launches of several of those brands, that's probably the most exciting thing I've seen.
Okay, and what is your personal favorite type of hotel and favorite amenity besides the basic requirements? And I kind of want to go down the line here on this one.
Boy, that's tough. My kids love home too, so I obviously love home too, for that matter. Honestly, I think it has to do with service. So if you receive great service in a hotel, I think that's really what I'm looking for. So I wouldn't say it's any one particular brand. I would say it's a service level, appropriate service level that I would strive for.
Okay, great.
I'll skip the brand question because there's too many Hilton people in this room. I might upset somebody. But I think going back to, Chris mentioned this around the experiential economy that we're in, and I think you're seeing the amenitization of hotels lend itself toward that, toward that consumer mindset. For me, I'm staying at a hotel in South Beach, and they had bikes there, free bikes that you could just use to go around, and to me that was a pretty cool amenity, just to have that experience.
I may not be the millennial on the bikes, but my favorite amenity is a rooftop bar. Does that count? When I'm the guest? I mean, especially when you can double the revenue that you can through the rooms on a hotel F&B. So
absolutely, we love those. So.
Just my 2 cents, right?
I appreciate that. You saw our deck, I guess.
I should have studied it better. And while I'm sucking up, my favorite brand, I will say this because I do mean this sincerely, my favorite brand is Home 2, and more specifically the Home 2 True combo. Tell me if you're doing any of those.
You're killing it right now.
So, and that's not a lie. I'll go in detail. So build a Hampton Inn, which is Chris's favorite brand, right? So build a Hampton and a Home 2 right next to each other, and I'll use round numbers. It costs you the same to build them, 100 rooms, whatever. It costs you the same to build. If you go to the NOI, because of the operating efficiencies of the extended stay, Home 2, the Home 2 will have $1.2 million NOI, where the Hampton will have $1 million NOI. So when you come to me to sell it, one, you're getting more cash flow, and two, I can sell it for more. The reason I like the True with it is you can keep the extended stay more true to extended stay in the Home 2 model, and the True, you can slough off all the transient business to the True, and it's an inexpensive box, so it's a really nice combination that can maximize returns.
He knows his numbers.
I didn't make that up.
So as a guy that travels over 100 nights a year, consistency is one of the things you mentioned earlier. I am the guys that work with me laugh because I'm like the no frills guy. So I'm there such a brief time. It's to sleep and leave, not eat or drink or anything like that. So, but I like consistency. So personally, I'm a fan of kind of the basics, and Hampton's one of them. The other brand has one or two that I like too. But from a financing perspective, it's interesting because I shook my head when you were talking about Hampton. I thought, geez, our credit guys, we buy a lot of bonds and things like that, and not to get into this, but as an investor in loans as well as a lender, our credit side is very, very strong and often a thorn in our side on getting loans approved. And when I say, geez, what do you like, for God's sakes? You keep saying or whining about this or that, and they're like, give me Hamptons. They're like, they perform the ups, they perform the downs, and they compete up and down. And so anyway, it was funny. They and Home 2 they talk about a lot recently too. So two different answers to one question, but
a general trend. Thank you guys for that. Going back to the rates, you talked about the low interest rates, Rich. Obviously, in the CMBS world, you haven't seen much movement on spreads, so that's made it attractive. But what are the general pros and cons specific to CMBS for both buyers and sellers of assets today?
So I'll start, I guess, with the cons. The easy ones from a CMBS perspective, it's long-term fixed rate, like I told you. We're selling these loans. So our buyers want call protection, they call it, which is said differently, is they don't want to get paid off early. They want this bond to be out there for 10 full years, not 9, not 8, 10. So prepayment flexibility is very limited. There's a big penalty for it. I think, you know, there's rigidity within the product that is probably the one big negative. On the positive side, to repeat, it's 10 years, it's non-recourse, and it's fixed rate. And I think that's kind of the basic, simple, without getting into a million nuances of it. Those are the two big things, and you're able to lock down up to 70-ish% LTV for 10 years.
Well, we know about those prepayment penalties, but agree, you know, you always ask yourself how low can the interest rates go, because locking in definitely has its advantages. Obviously, it's more on stabilized assets, but Teague, you know, playing devil's advocate a little bit, are there other financing options more attractive to buyers right now in the marketplace?
Yeah, so at the risk of, I'll be controversial, so I don't care for CMBS at all. Maybe I should say it a different way. I'm a transactions guy, so I value flexibility over anything. Said a third way, match your loan to your hold period of your asset. So if you're in an opportunity zone and you're going to hold it for 10 years because you're going to get that tax credit, great. Go put a lock in a low interest rate. It's the cheapest money you can get out there. It's non-recourse. It's amazing things about CMBS. You can lock in, you can hold it for 10 years, ride that asset out, and you're going to love it. Do not put a CMBS loan on it from Rich and call me 6 months later and say, hey, Teague, I'd like to sell this hotel. Because you can't. You can. You're going to pay him $1 million in defeasance. And that's probably you're not going to be happy, so it's not going to work.
100%. We try to squeeze in a little flexibility in there that other people don't.
The loan, but yes, yeah.
Talking about the added mezz piece after a certain time period and little things you can do, but absolutely, I think it's about the whole period and the type of deal that you're looking at, you know, the cash flows and how much proceeds you can get out of it. So financing is definitely an interesting time right now, and also looking, you know, credit is cheap. But you have to be looking at that exit and what it'll look like then and what you can bake in at those rates. And whether you go interest only or you start the amortization, which we've done for a lot of our assets. Going back to the market and specifically hotel, Teague, how active is the market today in hospitality and where do you see cap rates headed?
Okay, let's answer both of those. So I see the market is as active as it's been in a long time. Where are we? I think we're fundamentally in a deteriorating environment. I think we've been in a deteriorating environment for 24 plus months, which means cap rates are softening, so cap rates are rising. But I think that's the joys. I'll use Chris's analogy, the third trimester. We're in the peak of the market. It doesn't mean we're declining. It doesn't mean the world is falling apart. I don't see that happening at all. But fundamentally, I see the Wall Street guys are net sellers right now. So in institutions, which I actually think is good news, because then it provides opportunities for local guys to come in and do what they do, fix it, make money. But there's more opportunity out there. The industry guys, the Blackstones, whose tentacles are very long, they'll be both the largest net seller this year and net buyer because they have that much capital, they have to do it. But they fundamentally said 18 months ago, we're selling everything, and they've been trying to unwind. They consolidated, they came and bought 1 from you, 10 from you, 20 from you, consolidated. They tried to, in 13, 14, 15, because they saw the industry going up, they tried to sell it all to China. China cut the spigots off. There's no bigger fish. So they've reversed gears, and they've started selling it back. We'll sell 1 to you, 2 to you, 3 to you, and they're sending it back down, which, in my opinion, is opportunity in this room. The problem has always been, oh, we can't find anything to buy. We can't find any product. We can't find any product. There's plenty of product coming on the market right now. And why is that? I don't think they think the market, they're running for the hills. I think they are an investment fund as well. They have a 3 to 5 year time horizon. When did I say they were investing? 13, 14, 15? What's today? They can't hold on to the assets at all. They got to cycle through. It's a new institutional world that we're living in.
Perfect. We talked about supply and how we felt it was relatively, kept in check when you look at the last cycle. Matt, how do you feel about it right now? Where are the pockets that, at least in terms of where do you draw the line in different cities and markets, and what do you guys look at in that respect?
Yeah, and Chris mentioned it's about a 1.9% supply right now. And, if you look at specific markets, you have to look at it opportunistically and on a case-by-case basis. Some of the markets that were up on the screen that showed kind of the highest amount of supply and thus the lowest amount of growth from either RevPAR or ADR perspective, I think probably have gotten hit and bigger, like New York City, et cetera. However, I really believe that you have to look at each investment opportunity on a case-by-case basis, which is exactly what we do internally as well. We've actually denied more deals this year than we ever have due to impact. You know, that's something that we don't really see slowing down too much going forward. So we are having to turn away a few deals that maybe historically, if markets were in a little bit better position, then we'd be able to do them. So, you know, again, the sky isn't falling, as many have said, but we're in a really interesting time. And I think, you know, the majority of our owners, like yourselves, are veterans in this industry, and they're being cautious, right? They're taking a look at these markets and looking at the opportunities and really pinpointing the exact opportunity that meets all of their thresholds. And so in that regard, I think that the numbers, the growth numbers are going to sustain kind of at the level that they are.
Now you've seen new, unique concepts that trend to add local product in different areas. That, you know, that it's bringing about new brands. You talk about Margaritaville, Virgin, Citizen M, Oyo, Yotel. So how do you plan for that? How do you see that affecting and changing the industry? And I'll go also to Kellen afterwards on that.
So how do we see those affecting our business? Or, you know, many of those brands that you mentioned don't play in the same spaces that we do, so I don't think that we really look at them as true competitors. In certain leisure markets, they may, depending on the assets that we have. But if they're coming in with a product in a market that's a direct line with us, you know, we've got such size and scale. Our properties are able to perform and weather the storm in most of those cases. And again, as far as launching our own brands, you know, we take a very detailed approach to that, and looking for that white space and finding areas where and customers that we're not currently hitting today.
Project Spark, the next announcement.
Yep, it is.
So
January 16th.
Sure. Yeah. My take on the topic of some of these emerging brands, whether they're more leisure, urban micro, or whatever you want to define them as, I think to me they all fit into this category of emerging growth brands. And we talk about 0.9% RevPAR growth for this year. Whether you're a REIT and you're captive to that RevPAR growth because you, by definition, aren't growing with new units as the brands are, you're looking for where is the growth. And so I bifurcated into those two buckets, the owners and the operators. The owners, we've started to see a transition of the big owners into some of these brands. I don't think we've seen a REIT yet own a Citizen M, but we do have REITs owning Margaritavilles. We do have REITs owning the one hotel here. Host Hotels recently bought that. And some of the other more emerging brands. On the operator side, what's relevant to our business and more the corporate landscape of transactional M&A, we see the bigger brands, you know, looking at their brand bar and saying, where do I have the gaps? Am I going to develop or am I going to acquire? And are you going to develop and acquire to get into the all-inclusive space in the Caribbean? Am I going to develop and acquire to get into a new market in Europe? But a lot of these more growth-oriented brands that are catering to the lifestyle segment, maybe the millennial traveler, are definitely areas of interest amongst some of the bigger corporates that are focused on finding those other areas of growth, not just on a RevPAR basis, but where there's new unit growth, which by definition means we're going to have an owner base out there that sees that as a growth opportunity.
Absolutely. Now, you recently worked on Oyo. Why don't you talk a little bit about that model and what do you see with that?
Yeah, Oyo is, look, it's an interesting platform. I think a lot of people, frankly, are still trying to figure it out. I'd imagine everybody on the stage is trying to figure it out. What does it mean for transaction activity? What does it mean for impact to new supply in certain markets? And look, I'd say we're in an environment now where technology can enable and disrupt just about any industry. There are no sacred cows left in this world. Hospitality is no different. I think, though, that when you look at OYO, and for those of you, by the way, it's so new, I think a lot of people don't even know what it is, frankly. OYO is originally an Indian hotel company that plays in the economy space and taking independent hotels, converting under the OYO flag, and effectively growing through a franchise model. And I think by the end of this year, they're expected to overtake Marriott, more hotels than Marriott in the world, which is almost mind-boggling. But will they really disrupt the industry, and are they going to be a long-term player? It comes back to the kind of key tenets of delivering service, delivering hospitality, and delivering loyalty. I think it's a new and disruptive model, but I think a lot to be proven over time for that model to really continue to resonate over decades.
Last one while I'm sticking on you and I have you here. Aimbridge and Interstate merger. For those of you who don't know, two of the largest hospitality operators in the industry at a record price. Talk to me a little bit about what drove that and how that might change the landscape and create opportunities.
Sure. So a couple of things to think about on the Interbridge, maybe we should start calling it Interbridge. It's a pretty good name. Interstate and Aimbridge merger. So the two largest independent hotel management companies in the country, which we advised Kohlberg, who is the owner of Interstate. That was a transaction driven by private equity, so first and foremost. So sponsors own both companies, both platforms. And so in part, it's life cycle of funds looking for exits, and it's another Advent who owns Aimbridge looking to deploy more capital in a roll-up strategy, which they've been very effective at. I think it's in part driven by the fact that you've got institutional sponsors looking to grow and exit, in part driven by later stage in a cycle looking for growth. And where do you find growth? You find it in M&A through synergies, and by cost synergies through merging two platforms, and maybe through procurement and others by generating benefits of their economies of scale. But I think the ripple effect, is part of where I'm going with, the ripple effect to the rest of the hotel industry is you've got now really a 1,000-pound gorilla that's an independent operator that in a lot of respects is a preferred independent operator from some of the major brands and owners. And the question is, does that scale benefit them in ways that overcomes maybe their lack of sharpshooting focus? Right, because you go back to the third trimester, and you want to be aligned with an operator and owner that knows the markets and knows where to find the seams. When you've got a massive company like that, do you lose any of that? I don't know, but I would expect to see more consolidation in that space as well.
Interesting. Going back to the products and the differentiation with the landscape. Rich, how do you finance these? And talk about financing these new brands and products that pop up, and also the Airbnbs and Sonders out there.
So we're not the most innovative when it comes to which a lot of these new ideas. Not that they're not great ideas, et cetera, but our market, sort of the tail wags the dog. Our investors say, we're familiar with Hilton, we're familiar with Marriott, we're familiar with IHG, so we're okay with those brands and the brands underneath the umbrellas. And provided you have cash flow history, which is what we're lending on. Again, as Carlos mentioned, we're lending on stabilized assets, so we need that cash flow history to do it. So we're looking at new supply dynamics, heavily on the operator, incredibly heavily, in reverse order, and the flag that's on it. So, and the term of that too. But there are little things underneath each of those that we really focus on. But a lot of these newer ideas, again, looking to the history, for one, they don't have the history to look back to. And two, you don't have that sort of intrinsic value of a brand and a reservation system that's so established and that has been tested through cycles and things like that. Again, not that they're not great ideas and not that they don't work marvelously, but for our sort of end buyers, they're not something that they really have an appetite yet for.
Well, I think it's interesting when you look back at the last cycle and what happened during the recession, right? I worked at L&R, and ultimately it was the ones with the strongest reservation systems that prevailed, that kept that base business going, even when others, struggled immensely. Kind of
and to be clear, I don't mean like the new ideas for brands within these families. I mean like the you know, Airbnb, not that we could finance like an Airbnb, but Sonder and some of these other guys. I didn't mean like.
Well, Sonder, the concern is just the tech growth, like what are the valuations based off of, right?
Yes.
That over-expansion aspect of
Yep.
it. Teague, what do you love about hotels as an asset class?
So I listen, I was born and raised in this business. My father was in the business, so I've grown up in it. Family trips when we're 6 and driving to the beach or anywhere, and you had to pull over and look at 6 hotels on your way. So I know it really well. What I've always loved about it is it's complex, it's complicated. It's the same reason why some of the Wall Street guys don't like it, because it's complex and complicated. They want to invest in an office building that you lease for 10 years. To me, that's boring. It's also anyone can do it. So I think of the hotel business like golf. You play it all you want, you're not going to master it. You can get better than the next guy, and you can outperform the next guy. But whereas if, I don't know, bocce, bowling, pick something up, like an amateur and a veteran can probably be pretty close. So that may be a long, complicated answer, but I like it because it's complicated. So you partner yourself with, here's your answer, with what Chris said earlier and Rich just said, have good sponsors that know what they're doing, and you can maneuver in this space. Whether you're at the peak of the market or the bottom of the market, everybody can do well. At the peak of the market, you better partner with smart, talented partners who've been through cycles, who've seen it in the ups and downs, who know how to develop, who know how to manage, who can take that old junky hotel, turn it into something nice, take that new hotel, operate it better, figure out how to move in the seams, as Chris's words, mine's move in the margins, figure out how to make money in all markets, up and down. I like it because it's complicated.
We do too. Matt, question for you on the OTAs. Do you see long-term an ability to drive that cost down to unlock more profitability, both for the brands and the hotels?
Chris, you want that one?
Simple answer.
Yes, I'll say yes.
You don't have to here. Doesn't have. At present, would you buy an existing hotel or commence a ground-up development?
I think, again, you have to look at that on a case-by-case basis, right? You look at the market dynamics, look at the particular asset, if it's an existing hotel, or the site constraints, benefits, advantages of having a new build. So I would say that you could be equally successful in both scenarios as long as you do your due diligence correctly, and as long as you flag that with one of our brands. So.
Which we're doing a lot of.
Exactly.
Kellen, what do you think?
Look, it's hard to answer that question without saying it depends, right? It totally depends. You first think about, number one, are you a long-term holder? Like, what's your hold period, and what's your willingness to take on the commitment of time that development by definition requires? So what's your hold period, and then look, what's the market, right? So what does the market need? Does the market need a new hotel, and your ability to steal share and attract new share? It all depends on your assessment of the market. I'd say, from a financing perspective, putting the financing hat on, it's abundantly simple and easy to finance cash flowing assets today. It's getting harder to finance developments. So when you think about the financial return on the investment, you just got to think very critically about what is that development financing you're getting, and how might those returns compare to a stabilized asset.
Teague, looking at deals that have recently been developed, CO deals, do you see an opportunity given the rise in construction costs?
Oh yeah, and that's a great point actually. Good question. Everyone's been complaining that construction costs are going up so much, which I get. I also think it's helped hold supply in check, which has been nice. And what we've been able to do to that nuance, you can build a hotel and it takes you 3 years to develop the thing. By the time you open it and you haven't hit number one, you haven't opened up, we can sell it to the stabilized owner that says we couldn't take the risk for 3 years, and we'll pay you a nice premium over that because costs have risen, and we can underwrite it, we can justify it, and it's now an 8 cap on projection, and it's in a very nice profit for the developer. We're doing that a lot.
That's why we like playing development and acquisitions. Now, Rich, I won't even ask you. I know you're the steady acquisitions guy all day, so everybody has their appetite. Overall, what is your crystal ball hold? Hospitality next 10 years. Quick answers down the line. And then we'll leave it with parting thoughts. I guess, Matt, why don't you take it?
Well, no matter where technology takes us, people matter, right? So I think hospitality will in itself be relevant 10 years from now, and we're banking on that as a company. That's my quick answer.
Real quick, and Teague, you've used the word peak a couple times. I don't like to use that word. It's just, for me, it's a four-letter word. Partly because you could look back and maybe it is a peak, but I think more likely you look back and say this was just one other bump along this march, right? Because we're in this unusually long and extended cycle, and yet we continue to have great, consumer tailwinds that are going to support travel domestically and globally. And so I think I'm actually very optimistic. We might be in a low RevPAR growth environment, but very optimistic about, the future of travel.
Yeah, to defend myself. We were at a peak in July of 2015. From a transactional spend, we absolutely were at a peak in July of 2015. So anyone that's like, oh, we're at a peak, you should sell everything, or hoard cash, waiting for the downturn, you've missed 3 really good years. So peak's probably the wrong word. Thank you, Kellen. But the joys of being towards the top, right? And you're working in a band. I would say my answer is going to be a lot longer than both of theirs. I would say my answer when people ask me where's the market right now, I see lumpiness is my current answer. Some markets are up, some markets are down. And it's not, you can't say, even though STR does a really nice job of saying here's the markets, you can't really say here's the markets are up or down. It's a street corner business. Part of complicated, I can't just tell you to go to Austin, Texas. Good luck. There's tons of supply. I can't tell you to go to Nashville. How many hotels are you building in Nashville right now? 30-something in Nashville. He's not going to say that. Oh, by the way, you know how many there were last year in Nashville? 30-something. Hilton, just Hilton. Marriott's got the same amount, etc. Oh, by the way, anything in Nashville over the last however many years has been a phenomenal investment. So I can't tell you. Here's the other examples. Let's use similar markets. Northern Florida, college towns, Tallahassee, FSU, Gainesville, University of Florida, right? I've got a residence I'm selling active right now, one for Blackstone, selling one for Starwood Capital, back in that individual 111. They bought it all in bulk, now we're selling it. One market is up 10% and one market is down 20%. That's not a broad brush, that's realistic, that's actually happening. Yeah, make everybody guess, we'll see. But I'll give you the answer. Tallahassee is up 10%, Gainesville is down 20%. I could argue Gainesville was a better market. Well, you know what happened? Why is Gainesville down? Everybody showed up and built in Gainesville. So what's the number one problem? Supply. It is, it will be, it always will be. Supply. So to get somebody that knows what they're doing to check the supply report and say, oh, are we going to come or are we not going to come? What was Carlos Sr.'s excuses? Sorry. Supply. He missed the supply on all of his losers. Not losers, they're just challenged. Maybe they're opportunities. We'll get there. Right? Their supply, underestimated the supply. That's what's happening. It's going to come. It's going to continue to come. We got new brands popping up. We got new segments popping up all the time. Watch the supply. You got to be smart on the markets that you go to. If you think Cocoa Beach, there's an absolute opportunity for a new hotel, I totally agree with that. I'd be developing all day long. If you find nice cash flowing assets that you underwrite, these are going to cash flow, invest in those.
So where are we in 10 years?
It's a great market. I'm so bullish just in general. With the right operating partner. Everybody's waiting for a downturn. Guess what? Everybody's got cash in their pocket. They're loaded. It's been a huge bull run that we all know. Everybody's flush with cash. There's no opportunity because everyone in the room's got money. So you can't find we're going to find a real distressed opportunity. Yeah, good luck. So's the guy next to you and the 6 guys in that half of the room and everybody. In the downturn, the reason you were opportunities is because no one had any money. You were broke. The banks didn't have any money. The individuals didn't have any money. You had money. You were trying to save the investments that you did have.
I think our team underwrote about 100 deals this year. It was tough, but that's what it is. It's uncovering, that gem, that diamond in the rough, and finding those markets with good enough barriers to entry or a unique, proposition within the market. And that's, kind of trying to hit it or the right timing and buy. Rich, what about you?
So my crystal ball, we're in the debt business, not the equity, so the crystal ball is always looking backwards, really. But, I would say it's market by market, very, very much looking at new supply. And the other thing I'd layer on is our experience is, if you look at market by market, what's driving job growth for a lot of these markets and companies growing, which are attracting travelers and employees, et cetera. a lot of it is the tax system there. So when you look at a lot of the markets that we're concerned with lending, and it's not just hotels, it's a lot of markets where people are leaving. The taxes are way too expensive on a state basis, obviously. So some of those markets we look at because a lot of times, coincidentally, the margins are tighter because their expense base is a lot higher. So those are the ones, you know, and you can point to a few different markets where locally, for a variety of reasons, they've got real estate taxes that are all over the places. So those things, and then heading into 2020, and this is an apolitical comment, fact, there's an election coming. So that's some uncertainty that's out there. So that's something we look at. It's not like we're just being cautious and saying, not that we're not lending, but we're lending with the right people on the right flags.
Well, hopefully that keeps the supply in check a little bit longer, right? That's the goal. Well, thank you all for listening, and thank you again for the panel for participating. Is there any words of wisdom, anything that we missed covering here, or was that a wrap? All right. Thank you all again.
Nice to see you.